Hello battery metal fans. In today's video we examine if higher capital intensity projects have lower operational costs. i.e., is there a trade-off? Can you increase the capital intensity to reduce the opex, or vice versa? Secondly, we look at capital intensity and operational costs relative to valuation. Projects with lower capital intensities and lower operational costs should be higher margin and generate higher level of returns, assuming the products sold are the same. As a result, we'd expect projects with lower capital intensities and lower operational costs to have a higher valuation than projects with higher capital intensities and higher operational costs. But let's see what the market thinks. First, we're going to look at carbonate projects. Here we can see that there is a medium correlation that is statistically significant to a confidence interval of 80%. So in this chart, there is a relationship between capital intensity and operational cost, but it's not the relationship we would initially expect. In this chart, we see that projects with higher capital intensities also have a higher operational cost in general, so they are more expensive to build and operate. But what about valuation? The numbers above these data points are the enterprise value in US dollars per attributable ton of contained lithium oxide. What we can see in general is that the lower opex and capex projects largely have higher valuations, though there are some anomalies. Next, let's look at the hydroxide projects. Here there is a medium correlation, but it's not statistically significant, so the relationship between the capex intensity and operational cost is not clear. Some high capex intensity projects have lower operational costs, while some have higher operational costs. Now let's add in valuation. The relationship between valuation, operational cost and capex intensity is also not clear in hydroxide projects. Some companies have very high market valuations, while others have very low, and the operational metrics between the two aren't that different. Finally, we look at concentrate projects. Here there is a low correlation between the capex intensity and operational cost, but it's not statistically significant, so there is no clear relationship between capex intensity and opex. Once we add in valuation, things get more interesting. Here we can see that some very similar projects in terms of operational cost and capex intensity have very different valuations, or some of the lowest opex and capex intensity projects also have some of the lowest market valuations. These projects are African projects and are being given a large geopolitical risk discount compared to their peer group. In conclusion, carbonate projects with high capital intensities tend to have higher operational costs, and lower capital intensity projects and low operational cost projects tend to have a higher market valuation. For hydroxide projects, there is no clear relationship between capital intensity and operational cost, and indeed valuation. For concentrate projects, there is no clear relationship between capital intensity and operational cost. But African projects have a market valuation that is at a substantial discount to the Australian and Canadian projects. Thanks very much for listening. Please like and share this video with your contacts. You can download all our research for free from our website, and you can follow me on LinkedIn and Twitter.